Dana drives for Uber and Lyft. She saves her tax money and waits until April. Marcus does almost the same work, but he sends the IRS money 4 times a year. Dana thinks Marcus is giving away cash too early. Marcus thinks Dana is playing with fire, and both of them are right. And both of them are wrong, because after 15 years, the difference between them may be much smaller than you think. But first, watch what happens in year 1. Dana and Marcus start from almost exactly the same place. They are both 34. Both are single. Neither has a W-2 paycheck. Neither gets an employer 401(n) match. Neither has employer-sponsored health insurance. And neither can count on the same paycheck arriving every Friday. They are gig workers. Some months are great. Some months are brutal. Dana drives Uber and Lyft full-time, with delivery work filling in the gaps. Marcus does the same kind of work, with a few freelance delivery contracts on top. Over a normal year, each expects roughly $80,000 to $100,000 of net business profit. But normal is the important word. One quarter might produce only $14,000 to $18,000. Another might produce $28,000 to $32,000. There is no corporate payroll department quietly taking taxes out before the money reaches their bank accounts. For independent contractors, the IRS generally expects estimated payments when withholding is not enough. Those payments cover both ordinary income tax and self-employment tax, and that self-employment tax is the part Dana and Marcus cannot ignore. For illustration, take $90,000 of net business profit. The self-employment tax calculation generally starts with 92.35% of net earnings. At the 15.3% rate, that produces roughly $12,000, $13,000 of self-employment tax at this income level. Then comes ordinary federal income tax. In our simplified 2026 model, after the standard deduction and the deduction for half of self-employment tax, total federal tax lands around $19,000, $26,000, depending on whether annual profit is closer to $80,000 or $100,000. State taxes are not included. Neither are every possible credit or deduction. This is a comparison model, not a tax return. Dana sees that number and makes a decision. She will keep the money. Marcus makes the opposite decision. He will send it away. On the first day, Dana feels smarter. She gets paid. The money stays in her account. She transfers a chunk into a separate savings account labeled taxes. And every time she checks the balance, it gets bigger. $4,000, then $9,000, then $15,000. Eventually, it can reach roughly $20,000, $26,000. That feels powerful. Marcus has a completely different experience. His account keeps getting smaller. April comes, he pays. June comes, he pays again. September comes, another payment. Then January again. He watches thousands of dollars leave his account before tax day. Dana looks at Marcus and thinks, "Why are you giving the government my money months early?" Marcus looks at Dana and thinks, "Why are you pretending that money belongs to you?" At this point, neither one has won. For the first year, Dana loves her system. Her tax account is earning interest. Her cash remains under her control. And when a slow month hits, she knows the money is still there. That matters, because gig income is not smooth. If a car repair takes her off the road for 2 weeks, Dana may suddenly lose thousands of dollars of expected income. If demand falls during a slow season, her monthly cash flow can shrink dramatically. Marcus has less flexibility. His estimated tax payments are already gone. He cannot call the IRS and say, "Uber was slow this month. Can I have that money back?" So Dana has this psychological advantage, and she also has a legitimate financial advantage. If her tax reserve sits in a savings account earning around 4%, 5%, she earns interest while Marcus does not earn that same amount on money he already sent away. Over a year, that difference might be only a few $100s. But a few $100s feels meaningful when you are the person keeping it. Dana sees the account balance, she sees control, she sees liquidity, and she thinks she has found the smarter system. Then the real math begins. The first problem is simple. Dana's $20,000, $26. His own tax account is not wealth. It is mostly someone else's money. Her money is the interest. The tax principle is already spoken for. Then there is a second problem. Federal income tax is not the only tax on her freelance profit. Self-employment tax is sitting underneath the entire calculation. The IRS generally calculates self-employment tax on 92.35% of net self-employment earnings. So when Dana sees $90,000 of annual net business profit, she cannot simply think, "That's $90,000 I made." A meaningful portion has already been promised to Social Security, Medicare, and federal income tax. And there is a third problem. Waiting until April is not simply a different way to organize a savings account. The federal tax system is pay-as-you-go. If a taxpayer does not pay enough during the year, an estimated tax underpayment penalty can apply, even if the full balance is eventually paid when the return is filed. That changes the equation. Dana's strategy is no longer, "Keep my money longer." It becomes, "Keep my money longer, earn some interest, but accept additional tax timing risk." Now we can compare the two strategies honestly. Self-employment tax. Dana is responsible for both sides of Social Security and Medicare taxes applicable to self-employment. At around $80, $100,000 of net profit, the modeled self-employment tax is roughly $11,000, $14,000, before considering the Social Security wage-based transition at higher earnings. The IRS calculates the tax from 35% of net earnings, federal income tax. The tax reserve also has to cover ordinary federal income tax. In our simplified 2026 example, that can push the combined federal liability into roughly the $19,000, $26,000 range. The 2026 standard deduction for a single filer is $16,100, and the federal marginal brackets range from 10% upward. Estimated tax penalty exposure. This is where Dana's strategy can become expensive. Generally, taxpayers can avoid the underpayment penalty by meeting the applicable safe harbor rules, such as paying at least 90% of current year tax or the applicable percentage of prior year tax. Higher income taxpayers can face a 110% prior year threshold. The cash isn't really cash problem. Dana may see $20,000, $26,000 sitting in her savings account, but most of that balance is already committed. If she spends $4,000 because I have the cash, she has not made $4,000. She has borrowed $4, zero from her future tax bill, health insurance. Dana and Marcus do not have an employer paying part of their health insurance. If either buys coverage through an ACA marketplace or another individual plan, that premium is coming from the freelancer's own budget. It can easily become a four-figure annual expense depending on location, age, plan, and subsidies. The missing employee safety net. Neither character has the same employer-sponsored benefits that many W-2 workers take for granted. There is no employer-paid share of payroll taxes, no employer 401(k) match, and no company simply continuing a paycheck because business slowed down. The tax strategy exists inside a much larger cash flow risk, and that last point matters. Dana's April strategy is not happening in a vacuum. She is trying to manage taxes while also managing an unpredictable business. Now move forward 3 years. Dana has become very good at saving. She keeps her tax money separate. She does not spend it. She earns interest on it. That discipline is real. Marcus is still making estimated payments. The IRS generally divides estimated tax payments across 4 periods, with calendar year due dates around April 15, June 15, September 15, and January 15 of the following year. But Marcus has learned something too. He no longer treats the 4 payments as identical blindly. When his income changes, he recalculates. And because gig income can arrive unevenly, the IRS allows an annualized income approach in appropriate situations, potentially reducing early payments when income has not yet arrived. Dana has more cash on hand. Marcus has less tax risk. At year 3, the scoreboard is surprisingly close. Dana has the interest advantage. Marcus has the compliance advantage. And neither advantage is enormous. Here is where our illustrative model changes. Let's assume both characters have roughly $20,000, $26,000 of annual federal tax obligations. Assume Dana keeps the tax reserve in a high-yield savings account around 4%, 5%. She may earn roughly $400, $700 more per year than Marcus from simply keeping the tax money longer. That sounds like an easy win. But now add the cost of underpayment exposure, not a made-up 15% penalty, not the entire tax bill, just the actual cost associated with failing to make sufficient timely estimated payments based on the specific timing and shortfall. If Dana's annual penalty exposure, combined with the behavioral leakage created by keeping the money available, averages roughly $600, $900 a year in this illustrative scenario, her interest advantage disappears. That produces the crossover. Under these assumptions, Marcus overtakes Dana around month 25, not year 10, not retirement, about 2 years in. But notice what just happened. The crossover is not caused by quarterly payments magically creating wealth. Quarterly payments do not make taxes smaller. They simply reduce the cost of being late and force the tax money out of the spending environment. Change the interest rate. Change the income pattern. Change the penalty exposure. Change the taxpayer's discipline. And the crossover moves. That's the real lesson. Now take the comparison out to 15 years. Dana has spent 15 years keeping control of her tax reserves. She has earned interest. She has enjoyed liquidity. And during some bad quarters, that liquidity genuinely helped. Marcus has spent 15 years doing something less exciting. He has paid the tax obligation as the year progressed. He has sacrificed some interest, but he has also reduced the chance that April becomes a financial emergency. The long-term gap is surprisingly modest. Depending on income volatility, savings rates, tax accuracy, and penalty exposure, our model can produce an ending difference of roughly $3,000, $12,000 after 15 years. That is meaningful. But it is nowhere near the fantasy version where one strategy creates tens or hundreds of thousands of dollars out of thin air. Why? Because the underlying tax liability is almost the same. The fight is over timing. Dana's advantage is that she controls the cash longer. Marcus's advantage is that he controls the risk better. And there is another important detail. If Dana is extremely disciplined, the gap can shrink dramatically. If Marcus uses a smart high-yield cash strategy for the money he has not yet paid, the gap can shrink again. This is not an investing battle. It is a cash flow management battle. A has worked for it. B has waited for it. Dana has liquidity, control, and interest income. Marcus has less liquidity but more predictability and less exposure to an ugly April surprise. Neither one is foolish. They are optimizing different risks. Now give Marcus one small advantage. Not a second job. Not another 10 hours behind the wheel. Just one behavioral change. Every time Marcus receives a gig payment, he automatically moves an additional 1% of that payment into his tax reserve. It sounds tiny, but because he does it automatically, his reserve becomes more conservative during strong months. He does not have to remember later. He does not have to find $2,000 after a bad quarter. He simply moves a little more when the money arrives. And because the extra money is coming from the same gig income rather than from a new job, this is not free money. It is a trade. Marcus gives up a little more current liquidity to buy a larger margin of safety. Dana could technically do the same thing, but that would change the original comparison. Under our fixed scenario, Dana is deliberately optimizing for maximum cash retention until April, while Marcus is optimizing for payment certainty. To make Dana match Marcus on risk, she would have to change her strategy. To make Marcus match Dana on liquidity, he would have to change his. That is why there is no magical universal winner. Marcus can overpay. If he estimates his income too aggressively, he may send more cash to the IRS than necessary during a period when his business is struggling. He can generally refigure future estimated payments when circumstances change, but the money is no longer sitting in his bank account. Marcus gives up some interest. If his tax money could earn roughly 4%, 5% in a safe cash account, paying earlier means surrendering some of that interest. Dana's strategy has a legitimate mathematical advantage here. Quarterly payments can create cash flow pressure. A weak month does not care that a tax deadline is approaching. If Marcus has a repair bill, a slow season, or several weeks without enough driving income, a scheduled payment can feel painful. Quarterly does not automatically mean correct. If Marcus simply divides one annual estimate into 4 equal pieces while his income is highly seasonal, he may be using the wrong method. The IRS provides an annualized income approach for taxpayers whose income is uneven during the year. Now, when does Dana still win? Dana can absolutely win if she is extremely disciplined and keeps every dollar of the tax reserve untouched. She can win if her income is heavily backloaded toward the end of the year, and the annualized income rules legitimately reduce what she needs to pay earlier. She can win if the return on her safe cash reserve consistently beats the actual cost of her tax timing exposure. And she can win during a year when liquidity matters more than optimization. For example, when a major vehicle repair, medical bill, or severe income drop makes access to cash more valuable than a few $100s of interest. So Marcus is not the hero. Dana is not the villain. They are solving different problems. Dana still believes she made the smart choice. She looks at the money sitting in her account and sees freedom. Marcus still believes he made the smart choice. He looks at his tax calendar and sees certainty. And both of them are right, partly. Because the real mistake was never choosing April over quarterly payments. The real mistake was failing to calculate the entire system. The self-employment tax, the income tax, the interest, the penalties, the unpredictable income, the health insurance, the emergency cash, and the behavior that happens when a freelancer sees a 5-figure balance and forgets that some of it already belongs to the IRS. So the question isn't simply, should you pay quarterly or wait until April? The better question is, how much is keeping that money actually worth after every cost? And that leads to the next fight. Because there is another tax strategy that can make a freelancer earning $100,000 look, on paper, like they earn dramatically less. And this time, the question isn't when you pay the tax, it's how legally reducing the taxable income changes the entire game. So if you had Dana's income, would you rather keep the cash until April or pay quarterly and buy yourself certainty? Which side are you on?